For decades, right, sophisticated borrowers have put their trust in big bank brands for safety. It made sense. But today, we're going to dig into why that trust might not be a safety net, but actually a trap.
So, let's just jump right into it. This is the big question for our whole discussion today. Is your bank's brand really a safety net, or is it a trap?
Okay, to get to the bottom of that, we first have to talk about something called the myth of prestige. This idea that a big, famous name automatically means you're safe, that it equals financial resilience.
And this quote, it just nails the core issue perfectly. Reputation has long been mistaken for resilience. That one sentence, it really captures the fundamental assumption we're going to challenge here.
And look, for years, this way of thinking made perfect sense. The world's most sophisticated borrowers, we're talking ultra-high net worth individuals, family offices, top execs, they've always equated those huge Tier 1 bank brands with safety and, maybe just as important, with flexibility.
But, and this is the critical shift, that long-held belief is now being seriously questioned. The key thing to understand here is that prestige, it does not guarantee flexibility. In fact, sometimes the most recognizable brands can actually be the most constrained.
Okay, so that leads us perfectly into our next section. We're going to unpack exactly what this brand trap is and dive into a pretty subtle psychological quirk called reputation bias.
So let's define this thing, reputation bias. Now, this isn't about being naive or not knowing the terms of your deal. It's more subtle. It's that quiet little assumption in the back of your mind that your long-standing relationship with a bank will somehow bend the rules for you when things get rocky.
And this sets up a huge clash between what we believe and what actually happens. On one hand, you've got the belief, hey, my trusted relationship, they'll be flexible when I need it most. But the reality? Well, when market volatility spikes, the bank's institutional mandate, its internal rulebook, that is almost always going to win out.
And that is the brand trap. It's that exact moment when your trust in that prestigious name is so strong, it actually stops you from looking critically at the financial structure underneath it all. You end up trusting the logo more than you trust the fine print.
So how does this trap actually snap shut? Well, it's usually a four-step process. First, when things are stable, leverage is super easy to get. Then, step 2, volatility hits the market. All of a sudden, the bank tightens up. They start enforcing margin requirements and caps really strictly. And finally, the big revelation. The bank's internal mandate completely overrides your personal relationship. The trap is sprung.
This whole situation has actually created a new opportunity. It's fueled the rise of a whole new kind of capital. So let's take a look at the emergence of alternative financing as a really strategic tool.
Now, to be super clear here, when we say alternative financing in this context, we are not talking about, your average retail crowdfunding. No, this is specialist, structured, asset-backed capital that comes from non-bank providers. It is specifically designed for the kind of complex portfolios that sophisticated borrowers have.
So what really makes it different? Well, it usually comes down to 4 key things. You get bespoke structuring that's tailored to your specific assets. You get non-recourse frameworks, which is huge for protecting your wider estate. Decision-making is way faster, and there's a much greater tolerance for those concentrated or kind of weird assets that make big banks really nervous. And this really gets to the core philosophical difference. Traditional banks, they are built, first and foremost, to protect their own balance sheet. That's their priority. Alternative financing, though, is built to prioritize a negotiated alignment between you and the capital provider. It's much more of a partnership, not just a one-sided policy. All right, so that's the theory. Let's see how this stuff actually plays out in the real world with a couple of practical scenarios.
Okay, so this table gives us a great side-by-side comparison. In the first scenario, shareholder liquidity, the traditional bank offers a full recourse loan, and it takes 3 weeks to approve. The alternative provider, on the other hand, structures a non-recourse loan, which isolates the risk and gets it done in under 5 days. Huge difference. And for the second one, an asset acquisition with a tight deadline, the bank just can't meet a 48-hour deadline. The specialist lender, however, gets the capital deployed on time.
And this is the real kicker here. The crucial distinction isn't really the interest rate. Often they're pretty similar. The true difference, the thing that sophisticated borrowers really care about, is control and flexibility, especially when you're under pressure and time is running out.
So how can you actually apply this to your own situation? Well, it starts with something our source material calls the autonomy audit. Basically, a series of really sharp questions you need to be asking about your capital.
Okay, let's start the audit. Question number 1 is this. Does my current financing facility actually restrict the growth of my portfolio? Is it putting some sort of artificial ceiling on my opportunities?
All right, next up, and honestly, this one is huge for estate protection. Is the recourse broader than it absolutely needs to be for this specific risk? You got to ask yourself, is my entire net worth on the line for one single isolated loan?
Question 3 is all about digging into that fine print. Are there discretionary adjustments just kind of hidden in the agreement? Are there clauses that let the lender change the rules on you? Things like valuation haircuts or margin requirements whenever they feel like it.
And here we go. This is the all-important stress test. Question 4. How will this structure actually adapt if the market gets volatile? Have you really planned for that scenario, or are you just kind of crossing your fingers and hoping for the best?
And finally, this might be the most important question of all. In a worst-case scenario, who truly controls the outcome? Is it you, or is it the lender's risk committee? You have to be brutally honest with yourself about that answer.
So we're going to end on this really powerful thought from our source material. The shift from brand-based lending to structure-based capital is not ideological. It is pragmatic. It's not about being anti-bank. It's about being pro-control, pro-flexibility, and pro-true financial resilience.